What can crypto invader do during a bear market? The bear market is not something that any crypto investor likes to see. With an explosion of popularity in crypto and investors seeking opportunities to make as much money as they can. By attempting to capitalize on the ever-growing number of tokens and cryptocurrencies, in the way of creating new exchanges, for example, the so-called crypto winter is bound to happen. It does not mean that once the crypto bear market happens, you should stop investing in crypto and look elsewhere. There are certain takeaways from this occurrence, which is why we are writing this investor's guide to the crypto bear market. What is bear market? The bear market is when most crypto assets experience a dramatic drop in their price for a prolonged period of time. A bear market is essentially a time frame in the crypto markets when virtually all assets experience a large drop in value. This is usually caused by a large disbalance between supply and demand, meaning that big investors or just casual HOBLers start to massively sell their assets. This happens at a high price, and large trading volumes mean that the supply that is up for grabs becomes incredibly bloated, whereas the demand for such crypto assets drops, causing a price shift from an all-time high to possibly an all-time low. It is the polar opposite of the bull market, in which assets on the crypto markets are rising in their value and keep a somewhat normal balance between supply and demand. The prices tend to rise, not fall, as happens in the bear market. Assets usually experience all-time high prices during this period and relative stability, for that matter. The phenomenon of bear markets can be spread through multiple stages or phases, which can be characterized by using the good old Bitcoin. At first, there are high prices for a certain asset. Bitcoin, during its high price peak, was valued at almost $68,000 per single BTC. The prices remained at a somewhat steady high point, averaging at $55,000 all throughout 2021. The second stage is indicated by a decrease in trading volumes and an overall decrease in the pricing of the asset. This happens because initial buyers see an opportunity to net a hefty profit and exit. With Bitcoin, this happened in early 2022, when the price started to drop steadily, alongside trading volume, from the high point. At this stage, BTC's price was around $36,000. In the third stage, traders who bet and speculate on price fluctuations join in, hoping to get massive profits over the occurring price drop. This creates inflation of the price of the assets and a larger trading volume. With Bitcoin, this occurred during February and late March of 2022, with the price going up from $38,000 to around $47,000. However, these increases are rather small as investors notice that jumping prices are not there for long, meaning further short selling with day trading and so on. The aforementioned peak in the price of Bitcoin on the crypto market was the last one so far. The price is steadily going down and is just a mere $17,000 per BTC, signifying a bear market trend with the lowest price in recent times in November 2022. The final stage could be considered a recovery one. As the dust settles, if a certain crypto asset manages to survive this period, it should experience a rise in price, or at least a more certain stability at a low price point, meaning that there are no further huge decreases in the price. Relation to non-crypto economics. The traditional bear market is a term used when discussing stocks and the stock market. The meaning is the same, and there are even correlations between crypto bear markets and stock trends. Bear market, as a term itself, is not unique to crypto. It was first started to be used, and still is used there, when talking about the stock market. The meaning, however, remains the same. In the stock world, a bear market occurs when there is a steady and long decline in the stock market. It happens when a sudden switch from investor happiness and optimism to pessimism, fear, and panic. The rule of thumb in this regard is a steady price decline, standing at around 20% for at least 2 months. This period is called a bear market. The key example here would be the somewhat recent 2008 financial crisis that affected the whole world, leading to extreme price drops in all of the stock markets. Also, the panic buying/selling during the onset of the COVID pandemic, and of course, the 1929 Wall Street crash that caused the Great Depression. Interestingly enough, The stock market trends tend to sometimes correlate with the crypto bear market ones on a larger scale. The price drops in cryptocurrencies correspond on charts to those that are experienced on larger stock exchanges, such as the NASDAQ, a very influential stock index. Historical examples of crypto bear markets. There are setbacks related to both Bitcoin as well as other cryptos. However, as the crypto markets have macroeconomic tendencies, it is natural that ripples happen regardless of which currency is affected. Each major change is bound to create a global effect. Bitcoin is arguably the most popular cryptocurrency still going around, and the first crypto coin to go mainstream, so to say. There were multiple crypto bear markets related to it, all with different causes that are worthy of interest. The onset of crypto winter. The year 2018 was not a successful one for Bitcoin and the investors in it. This portion in time was widely dubbed as the crypto winter. It was an incredibly large crypto bear market that had multiple causes to it. In other words, one blow after another caused the price of BTC to plummet from an, at that time, all-time high of around $20,000 per Bitcoin to around $3,000. What started this bear market trend is debatable, however. One of the key catalysts in this occurrence is Coincheck, a Japanese cryptocurrency exchange that was hacked. At that time, it was the largest exchange in Japan, with hundreds of millions of dollars in assets and holdings. When the hack occurred, the criminals managed to steal $530 million worth of NEM tokens, creating a shockwave reaction throughout the whole crypto market, in turn causing a decrease in the price of Bitcoin. Although there is no particularly direct connection between BTC and the stolen currency, the general distrust after this occurrence spilled onto Bitcoin and the crypto market in general. Another blow came after the juggernauts of the internet, namely Facebook, Twitter, and Google, had banned any ads of initial coin offerings, further impacting the ripple effect throughout the cryptocurrency markets. It is worth noting that rumors centered around South Korea had a play in this bear market too. There were talks that a nationwide ban on all cryptocurrency trading is imminent in the aforementioned country, which created a further decrease in the monetary worth of Bitcoin. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.